Where to invest their money is a choice that investors have. It's critical to carefully consider all available investing options. Stocks, bonds, and cash equivalents are the traditional three fundamental categories into which investments are divided. Each category includes a variety of investments of various types. Since their main purpose is to protect your money rather than increase its worth, we won't discuss cash alternatives like money markets, CDs, or savings accounts. Here are 10 types of investments you might consider for long-term growth, and what you should know about each. Before starting, don't forget to like and subscribe to our channel for more future updates. So let's start. How to purchase different types of investments. Any investment you make will require a brokerage account. It is possible to buy and sell investments using a brokerage account, which is different from a bank account. A brokerage account may be opened in as little as 15 minutes, and once it is, you are prepared to start investing. You can make use of the tools on the broker's website to identify the investments you want. Many of them also come with learning materials to get you started. Number 10. Real estate management. You can invest in real estate and houses. Public companies, private businesses, homes, ranches, and trailer parks are all worthwhile assets if you treat them all equally. The hardest part of real estate investing is finding a home that is half as pricey as it is worth. Real estate investing can be quite rewarding if you can pull that off. It might be easier to invest in the stock market and get comparable or better profits. If you don't want to deal with managing a big number of rental properties. Direct property purchases, whether they be commercial or residential, are one way for investors to construct their real estate assets. Additionally, they have the option of purchasing shares of real estate investment trusts. Number 9. Stocks. An investment in a certain business is called a stock. A stock is simply a stake, or a small portion of the company's assets and profits, that you can buy. When a company needs money, it will sell stock in the company, which investors can then buy and trade. Although stocks may produce sizable gains, they are also riskier than other forms of investing. Businesses may lose all of their value or cease to exist. Let's quickly go through how investors get income now. When the value of the stocks an investor owns increases, they profit because they may sell those stocks at a higher price. Some stocks also offer dividends, which are monthly payments made to stockholders from a company's profits. Number 8. Bonds. Bond investments result in a loan being given to a company or government. When you buy a bond, you give the bond's issuer permission to borrow your funds and return them to you along with interest. Even though they may provide lesser returns than stocks. Bonds are frequently seen as less hazardous than equities. Like with any loan, the issuer defaulting is the main risk. The full faith and credit of the United States, which backs U.S. government bonds, completely eliminates this risk. Corporate bonds are frequently regarded as the next less risky alternative after state and local government bonds. Bond risk normally decreases along with interest rates. Bonds are a fixed income investment because investors may anticipate receiving regular income payments. Investors frequently get interest payments on a regular basis, typically once or twice per year. And the entire principal is normally reimbursed at the bond's maturity date. Number 7. Mutual funds. You're not alone if the thought of selecting specific bonds and stocks doesn't appeal to you. In reality, the mutual fund was created with investors like you in mind. Investors can buy a variety of different investments at once through mutual funds. These funds pool money from different contributors, combine it, and then hire a seasoned manager to invest it in stocks, bonds, or other assets. According to a predefined strategy, a mutual fund may invest in a specific class of stocks or bonds, such as international equities or government bonds. Bonds and equities are both investments for some funds. The investments the mutual fund makes will determine the level of risk. A mutual fund will distribute stock dividends or bond interest as a share of its earnings to investors. As the value of the fund and the investments it owns rise together, there is a chance to sell it for a profit. Keep in mind that paying an expense ratio, which is a yearly cost, is required when purchasing mutual funds. Number 6. Retirement. Two essential components of personal financial management are retirement planning and income management. When it comes to investing, tax-advantaged choices like a 401k or IRA may be a sensible choice. In addition to any potential tax advantages, your funds have the potential to increase over time. The Smart 401k website from FINRA is a great resource for learning about 401k plans. Whether you are just getting started or have already retired. When you retire, how you handle your income can mean the difference between a happy retirement and a subsequent financial crisis. Whether you are retired or just starting to save for retirement, there are things you can do today to manage your income. Number 5. Insurance. Life insurance products are commonly included in bigger financial plans. They can come in a variety of shapes and sizes, including term, whole, and universal life insurance products. Variations of these, such as variable life insurance and variable universal life insurance, also exist that must be registered as securities with the Securities and Exchange Commission, SEC. FINRA regulates investment advisors and companies that sell variable life and variable universal life insurance. Insurance products are regularly developed to fulfill certain objectives. For instance, long-term care insurance is designed to help you control the expense of your health care as you age. As with other financial products, insurance policies can be confusing and pricey. So it pays to do your research before purchasing one. Number 4. Bank products. It can be safe and practical to save money with banks and credit unions. And some of them even offer services to help you manage your finances. Thanks to the liquidity of transaction accounts and deposit accounts, you may immediately access your money for any purpose, from regular expenses to a down payment or cash for unforeseen events. If you have a checking account, you can send money to a person or company using a check or an electronic payment. Keep in mind that the interest you receive from bank products, such as CDs, is often smaller than the possible returns from other assets. Number 3. Index funds. A type of mutual fund known as an index fund passively tracks an index as opposed to engaging a manager to make investment choices. For instance, an S&P 500 index fund will own shares of the companies that make up that index in an effort to mirror the performance of the S&P 500. Because they don't have that active management on staff, index funds usually offer lower costs. The level of risk will depend on the investments made by an index fund. By using this strategy, investors may profit since index funds may generate dividends or interest that is given to investors. If the benchmark indices that these funds monitor increase in value, investors may be able to sell their shares of the funds for a profit. There are expense ratios for index funds as well, but as was already said, these expenses are frequently smaller than those for mutual funds. Number 2. Exchange-traded funds. ETFs, a type of index fund, try to duplicate the performance of the benchmark index they keep an eye on. Because they are not actively managed, like index funds, they usually have lower costs than mutual funds. The main distinction between exchange-traded funds, ETFs, and index funds is how they are bought and sold. Since ETFs are exchanged on an exchange like stocks, their prices will move often. On the other hand, the price of mutual funds and index funds is set just once, at the conclusion of each trading day. And it is unaffected by whether you buy or sell. Although most investors are unaware of the distinction, an ETF can be a better choice if you want more control over the fund's price. Investing in an ETF is similar to investing in a mutual fund or an index fund in that you hope the fund will appreciate in value and that you will be able to sell it for a profit. Investors may receive dividends and interest from ETFs. Number 1. Options. A stock option is a commitment to buy or sell stock by a specific date and at a specific price. Because you are not technically required under the contract to buy or sell the stock, options give you flexibility. As the name suggests, it is possible to achieve that. 100 shares of a stock are usually included in option contracts. To exercise an option, a contract must be purchased in addition to the underlying equity. The shares can then be purchased or sold at the agreed-upon price within the agreed-upon time frame. Or the options contract can be sold to another investor or allowed to expire. Although options can be complicated, at its most basic level, you are just locking in the price of a stock whose value you anticipate rising. If your crystal ball is right, buying the stock below market value will benefit you. You can choose not to purchase it if it is inaccurate, in which case you will only forfeit the contract's purchase price. Before you begin investing, make sure to educate yourself about the various investment types, how they operate, and the dangers involved with each. You can suffer a significant financial loss if you choose an uninformed investment plan. Before you contemplate the stock market, Consult a financial expert to be sure your finances are in order. This is it for today's video. What do you think of our video? Feel free to share your thoughts in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.